Well, hello and welcome to the show. We call this one Molotsky on Money. What's the show all about? Well, the clues are in the title. We'll be discussing money, specifically investment strategies, taxes, estate planning, insurance, and many other topics, all of it designed to help you and your family improve your overall financial picture. The Molotsky part of our title comes from our panel. Their name is Molotsky. Each week, we have Stan Molotsky, President and founder of the SHM Financial Group, as well as Lee Molotsky, Vice President of the SHM Financial Group. We invite you to stay tuned because we have some real good information for you on this show and every show that we hope you and everyone can benefit from. And tonight we're going to be talking about one of Stan's favorite topics, taxes, right? You just love talking about taxes.
Especially in the current political environment.
Right.
Yes. Right.
Actually, both of you have a tax background.
Yes.
Correct?
Yes.
And that background is what? If you could just talk briefly about it.
Well, you know, my background originally was in the securities business, and my majors in college were economics and accounting. So it evolved into the brokerage business and then the financial planning arena, and then Lee's background, which he certainly can.
Well, you can tell us your background.
I can?
Yeah, you're allowed to talk. Yes, that's right.
I said Lee's background.
Thank you. I studied accounting at the University of Delaware.
Okay.
He
So
worked-
so
yeah,
both of you have.
I worked for a couple
Right.
of the larger, what
Big Eight.
was then called the Big Eight accounting firms.
Right, and we're calling tonight's show, and we mentioned Stan and Lee's background because we're calling it tax mistakes that you can't afford to make. And we will be discussing that with relationship to investments. Stan, is that
Correct.
pretty much it?
Lee and I are not, practicing CPAs. We partner with entities that do specifically that type of work. So we get information from them, and our clients a lot of times utilize the services of those particular entities. So it's all part of the planning process, and it's a very critical part, especially in today's political environment where taxation seems to be at the forefront of the current administration's agenda in order to raise money.
Another one of your favorite topics,
Another
by the
one
way,
of my
right?
favorite
Okay.
topics,
Let's
yes.
get right into it, to our various points here. Again, tax mistakes you can't afford to make. Number one, not using tax-favored accounts. Okay, Stan, explain, please.
Well, again, there are so many different vehicles available today, and there are more and more as the days and months go by, where people can deposit money in different kinds of programs, whether they be an IRA account to take a deduction, a 401k account, a 403b, where the money goes in pre-taxed and then comes out taxable, or Roth, where you pay the tax and the money accumulates on a tax-favored basis, and even on individual deposits that you can make in tax-free things, whether they be tax-free bonds or different mutual funds that allow the money to accumulate without the tax obligation. And also there are insurance programs that allow money to be accumulated on a tax-deferred basis, which are great vehicles for certain people to do certain things. So it's just a matter of, no matter who anybody is dealing with, it's critical that they are at least exposed to all of the different avenues that they can utilize to take advantage of to protect their asset base so that their buying powers continue to be preserved, using the tax-favored things that we make available in our practice.
I remember, Lee, you showing us a chart a long time ago where you took money and you put it in something tax-deferred or tax-free, and then you took money, the same thing, and put it in something taxable, and the results were tremendous with regards to the tax-deferred and
Sure.
the tax-free. It was a major, major difference.
We always begin with, do you have a 401k or access to one at work? Answer is yes or no. Or I'm not sure. If you don't know, you really should find out. If you have one, take advantage as much as possible in maximizing as best you can your contributions to your 401k, because that enables your money to grow tax deferred over however long until age 70 and a half, when you have to start taking out later on in life. So many of the employers offer matching, many don't, but if you have an employer that matches, maximize. Even if you don't have an employer, maximize, because that's a great way to defer taxes. Also, outside of the 401k, like we talked about a little bit earlier and a number of weeks ago on this program, we talked about tax-deferred assets that are not 401ks, and those are called tax-deferred annuity contracts. So we use that in our practice for those people that have maximized their 401ks, maximize their IRAs, but are still looking for ways to defer the taxes on the growth of their assets outside of the retirement plans.
There are so many different things that people could take advantage of. I mean, there are things called 529 college savings plans. Well, you may say, I don't know if I could utilize those, but if you're a parent or a grandparent and you put money into these plans for children, grandchildren, great-grandchildren, the depositor, still own that asset, which means you have total control over that asset, but the money is growing on a non-taxable basis to be utilized specifically for the beneficiary's education, of which you can change to a multitude of different people. And if for some reason they don't need that or you don't want them to have it, you, the depositor and owner of that account, can then, at that point, cash that out and utilize that money and then pay the taxes. So it's another deferred program that you can utilize along with a multitude of other deferred and tax-free things.
Okay, we're talking about tax mistakes you can't afford to make here on the program tonight on Molotsky on Money, and we started out with telling you about not using tax-favored accounts, and this is another point, selling winners too soon. I'm assuming, Stan, you're talking about a stock.
Yes, stocks, mutual funds, ETFs, things that are stock market oriented. You get in a hurry, you have a profit, do you get rid of it? Well, depending on which account, and we're going to talk about that a little bit later in the show, whether you should have money in a retirement account or a non-IRA or non-retirement account from a planning point of view. But when you have a stock and in different environments, when do you sell that stock?
Right.
At what point do you take profit? Well, there's no answer to that because nobody really knows whatever's going to happen. But in our practice, we talk protection, 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 and we utilize different ways to protect one's profits in the stock portfolio that they have created in mutual funds and ETFs. And you can do that using selling options against your portfolio. You can utilize it by using what are called stop loss orders, or putting in the order, or at least watching it. So if the stock drops or the mutual fund or the ETF drops 3, 5, 10%, whatever number you are comfortable with in the planning process, then at that point you exit and walk away.
All right, we said selling winners too soon, tax mistakes you can't afford to make. Now this is the opposite, selling losers too late. Okay, now,
and again,
how do you figure this one out?
It's easy. It's the same thing. You have to have a strategy. And we like to refer to it, you must have, in today's environment, as well as in any environment, some form of an exit strategy. When you go in, you want to know how you're going to exit. Just like when you go into an airplane, you want to know where the exits are. You go to a movie, you want to know where the exits are. You go anywhere, you want to know how you can get out of wherever you are. It's the same thing when you're putting money into any kind of investment vehicle. Okay, the money goes in. When and how am I going to exit from that particular situation? If you put money into the stock market, stocks, bonds, ETFs, mutual funds, you have to say, okay, I'm putting the money in there for the purpose of it to accumulate over a period of time. But if it drops a certain amount, that's my exit strategy. I can't afford this particular deposit to be worth 30, 40, 50% less than what I started with. Therefore, if it drops X percent, I'm out. I have to move on and look for something else, or watch it for a little while longer and then maybe re-enter it, but you have to have some form of an exit strategy to protect yourself.
You also have to have, this is not a market where you just put money in and hope for the best. You have to do your homework.
The old buy and hold is gone,
you really
right?
have to do your homework, because there's a lot of money, a lot of big money that controls a lot of the market, and buying stock in a particular company, the company may be doing well, the stock may not be doing well for many reasons, but you have to watch and understand the flow of money throughout the market. So it's not just as easy as buying stock, I know it's going to go up because the company's doing really well. Not necessarily true. The company, we were just talking earlier this evening about putting money into a stock that has gone up. The stock has gone up significantly. The company happens to be doing very poorly, and
go figure.
Well, there's reasons,
and there's a lot of reasons,
but you find that in doing your homework. You would find that out. That's why you got to do your homework.
You have to keep track. You have to stay on top of things. You have to do your homework, And you have to have a strategy, like you said, an exit strategy before you get into the thing. You have to think, you have to have a discipline as to if you're going to get into this, what am I looking to accomplish by putting my money into this stock?
What is my plan?
Yeah,
what
what's the
is my
plan?
overall plan?
Okay, got to have a plan. More to talk about here on the show. It's Molotsky on Money. Tonight we're talking about tax mistakes that you can't afford to make. Yes, we have plenty more to talk about here on the show. Don't go away. With Stan and Lee Molotsky, I'm your host, John DeMasi. More Molotsky on Money right after these words.
Just as it's extremely important to have your automobile's brakes tested, we think you must have some type of safety net provisions in your financial plan. How are you protecting your bond positions from rising rates? How are you protecting your stock market gains from market sell-off? Do you have the proper provisions in your financial plan to assure that your income lasts as long as you do? Are you keeping up with inflation? Call 1-800-MONEY-SHM to schedule your safety net review. That's 1-800-MONEY-SHM. Not everyone can endure the ups and downs of the market. When planning for retirement, you can ride the roller coaster and take your chances, or you can eliminate the downs by properly repositioning most of your portfolio. If you're 5 years pre-retirement or 5 to 10 years into retirement, it's not too late. As a matter of fact, it's never too late to avoid the next down movement. Call the SHM Financial Group at 1-800-MONEY-SHM or check us out on the web at shmfinancial.com.
Welcome back to Molotsky on Money. Don't forget, if you'd like to contact Stan or Lee or any member of the SHM Financial Group during the week, you contact them by phone or by email or on the website. And we do put that up on the screen from time to time, so you may want to jot it down so you have the number. Contact them and any question you have. Or if you want to sit down with them and go over whatever your situation is, remember that initial consultation is complimentary. Also, if you'd like to see some of the shows, you missed some of our TV programs here. If you don't see it live, well, you can always go to the website and you could watch us on the web. What a world we're in today. We're everywhere.
At
right?
some point, we will actually be able to tweet.
That's right. Well, we're
First,
gonna
we have
get
to
it.
understand
Right,
what it is.
Yeah. Well, we're not of that generation.
Then we're
but-
going to tweet.
Okay, tonight we're talking about tax mistakes you can't afford to make. Let's get right back into it. We had a couple of points for you before. This one is putting the wrong investments in the wrong account. All right, Stan. This one is really confusing. Either one of you. When it says this, I don't understand this one. What do you mean?
Well, some people like stock, some people like bonds. Can't imagine who they are at the moment. Some people like fixed accounts. Well, I guess this is just my thinking. If you own a stock or a fund, and it's a growth stock or it's a fund, and it goes up in value, inside an IRA, there's no tax effect if you sell it, right?
Okay.
Okay. But when the money comes out of your IRA later on, it comes out as ordinary income. So my thinking is, simplistically, you want to own income-related instruments inside an IRA or qualified account. You want to own stocks and growth-style assets outside of the IRA for the following reason. If you hold the stocks a year and a day or more, they're long-term capital gains, which means that your tax bracket is lower. Okay, if you sell it at a profit. At the same time, if you own a stock and you put $10,000 into a stock and it falls down and you sell it for $7,000, you have a loss of $3,000. If you own that stock inside of an IRA, you can't write off the loss.
Because there's no tax on an IRA until you take the money out, correct?
Correct.
And
Okay.
the money's in an IRA. If the $10,000 that you put into whatever stock or fund grows to $13,000 and you sell it, there's no tax. But when that money comes out, it's taxed as ordinary income. So you get a dual-edged sword by having growth stuff inside of your IRA. You can't write off the loss, and the income or the asset, when it comes out, is taxed as ordinary income. Outside, in a non-qualified account, you can write off the loss if you're wrong and use some what we call tax loss harvesting. So we can write off the losses for certain positions and offset those losses against gains in some other positions and maybe net zero in taxes.
That's why I like working with you. I mean, I learned something on every one of these shows.
But
That's really a great explanation.
But you have to tailor it to each individual client as to what
Which is what you
best.
do, right?
Exactly.
That's what
There's
you
no
do.
boilerplate
See,
thing, but
the interesting
conceptually,
thing is some people they have a stock they love doing really well. Maybe they own it in their IRA. So if they own it in their IRA and you still want to own it, maybe sell it in your IRA. I'm just thinking out loud. And it's not for anyone specifically in particular. But if they own a stock that's gone from 10 to 30, maybe they want to take it off the table a little bit inside their qualified account. So they sell it inside the IRA,
no tax implications.
no tax, sit on the sideline, relax, but buy some of that stock outside the IRA so you still own it. Now, if the stock should go down from 30 to 20, and if you sell it, now you have a loss, which you can write off as a capital
Right,
loss or a
right.
short-term loss, and you still, but if you have a gain and you hold it a year and a day, now it's a capital gain, taxed at a lower bracket. So it's, you have to think how you want to own what you own. The question was, how to own what you own or where to own.
Putting the wrong investments in the wrong account. Right,
So
right.
you want to understand the ramifications of how you own what you own is just as important as what it is that you own.
And most of the time, people just do it, and their advisor just does it, and they don't think it
They don't
through
think all the different things that you just
ramifi-
talked about, right?
Exactly.
You need time. You need to sit down with people who understand the ramifications of the planning process.
All right, tax mistakes you can't afford to make. That's what we're talking about here tonight on the show. And this one is kind of a corollary, I guess, Stan, to the other one, selling winners too soon, selling losers too late. This was not timing income and losses correctly.
Well, here it's a matter of looking at whether it makes sense to take a short-term loss or a short-term gain, or a long-term loss or a long-term gain. So it's a matter of looking at each particular situation and determining what makes the most sense. Wherever you are in the particular calendar year, it makes sense to look at what you're doing to see whether it makes sense to you to harvest that short-term gain or that short-term loss to offset other short-term losses and short-term gains. So it's an ongoing process that the advisor should be constantly preaching to the particular client. That's their job, is to look at the different situations that they have and say, it makes more sense for you to take this gain now rather than wait for later, or it may make sense to wait till the beginning of the following year for the tax liability. It's just a matter of making sure that the advisor is on top of what the particular client owns and how they can best harvest the gains and losses in that particular calendar year.
Lee?
In a perfect world, one of our partners in the planning process is our CPA, because he or she should be advising, which unfortunately many of them don't, because they don't think that's their job. They prepare their tax return for the individual. But part of so when you're all done, January 1 comes, you start getting all your stuff in the mail in January and February and March, you go to your accountant, you have your taxes done. That's how most people function. That's not how it should be. What should be done is earlier in the year, kind of early to mid-year, you should be doing tax planning, not January, right?
Right,
Because
that's
it's
right.
too late.
You've said that many times,
So,
yes.
well,
Yes.
I'm saying now again,
Right.
you should be doing planning early to mid part of the year, because by the time December, January comes of the year, it's too late to do any tax planning. So you really need to strategize how you're managing your money and coordinate it with the accountant. Many people don't. So our job as financial professionals is to understand the tax effect just as much as it is that we understand the investment effect and the effect on tax loss harvesting.
And with that being said, one more before we go to break, which kind of ties into what you're saying, Lee, and this is ignoring special tax rules, which you were saying about tax planning. So now there's some...
I'll let that talk about special rules, but I'm just talking about coordinating the investment management of the assets along with the tax effect of doing certain things with those assets. So we talked earlier in the show about buying and selling within the IRA versus, and then offsetting a sale in the IRA with a purchase outside the IRA. Most accountants are not going to talk to you about that, but part of our job is to coordinate the whole plan.
Okay,
Well, plus-
ignoring special tax rules.
Well, again, I mean, there are certain situations that you could purchase that you may not even know what the tax implications are when you sell it or get a dividend from that particular thing. There are ETFs, which are exchange-traded funds that hold certain things, such as precious metals, gold, silver, platinum, palladium. Those things are treated differently than a regular stock when it comes to the dividends and when it comes to the profit or loss from those particular things. There are special tax rules that apply to those things, totally different than a regular individual stock. And if your advisor isn't making you aware of that, then they're not doing the job that you're paying them to do.
Get another advisor, in other
Well,
words.
I'm not going to say that, but yes, get another
Okay.
advisor.
More to talk about here on the show. It's Molotsky on Money. We're here every week at this time discussing a variety of issues, all of it, of course, financial in nature. We have Stan and Lee Molotsky. That's our panel. And I'm your host, John DeMasi. We return with more of this edition of Molotsky on Money. We'll do that right after these words.
Do you know what your risk tolerance is when it comes to your investments? Do you know exactly what you have in your portfolio? The SHM Financial Group have developed a very important program called a financial stress test. It's simple, quick, and can help you in your future financial plans. Contact the SHM Financial Group to schedule it. Offices in Collingswood, Voorhees, and Lakehurst, New Jersey. Call 1-800-MONEY-SHM. That's 1-800-666-3974. Call us to discuss the reverse mortgage concept. If you should decide to proceed, you're required to go through a 60-minute phone or office interview. We will provide you with a list of HUD counselors you can call who will provide you with the counseling. Call us at 1-855-HUD-REVERSE. That's 1-855-483-7383.
Welcome back to Molotsky on Money. Don't forget, contacting Stan or Lee Molotsky at the SHM Financial Group is very simple. We give out the phone number here. We have it on the screen from time to time, as well as the email address and as well as their website. And you can get a lot of information on the website, including you can view some of the shows in case you missed some of our previous TV programs. You can go on the website and view them as well, but do check them out and feel free to call them. Remember, the initial consultation is complimentary. Any of those reports that we've talked about here on the show, if you'd like to get one, or if you'd like to take one, feel free to call them and they'll be happy to explain it further to you. Tonight here on the show, we are talking about tax mistakes you can't afford to make. Let's get right back into it so we can give them all to you before we leave you tonight on the show. I believe that this one was written specifically for me. Not keeping the right records. My record keeping is the absolute worst. So that's one thing I haven't learned from you. But in any
You need a
case,
big box. You need a
yeah,
big
you need a
box,
big
you
box,
said.
and you need to have some kind of organization. But what do you mean by not keeping the right records?
Well, you have to know what records to keep
Right.
and how long you should keep them. And there's different rules and things that apply to keeping records for a certain amount of time and keeping the right things to make sure that, for example, of the stock transactions, which things do you keep, which slips do you keep, how long do you keep your annual statements, your monthly statements, and those kinds of things. Normally, you keep the monthly statements till the end of the year, and then at the end of the year you have the year-end summary, which then includes the previous 12 months. So then you can throw out those previous 12 months, things, and then when you have the end of the year, you save the end of the year statements and you put that with the tax return, and you constantly move forward, from there.
Lee?
In addition to the records, people have, quote, stuff scattered throughout the world, right? They have an account at here, an account here, an account at this bank, an account at the brokerage bank. You got 10 different places that they have their money deposited. And every month they're opening up 10 different places, 12 months a year, 120 different. How do you keep track of everything? Well, we've set up a system through one of our back offices so that by year end, all of that information will be able to be, you could keep them where you have them, but we'll be able to funnel them through our website and have one statement which coordinates and ties all of those 10 statements together.
So in other words, you would, once a service, I would go onto your website and I have, I guess, my name and my code.
That's
I would
correct.
click into that and then I would have every record of everything that I own.
Think of it like a shoelace. We're going
Right.
to take each shoelace, each of the 10 laces, and tie them in through the shoe. And you'll be able to have that one shoe will have all of your records compiled in there.
Well, the beauty of this too is you may be here, and you may have a brother, sister, son, daughter somewhere else,
Cousin,
who you may want to have
Elder
access
parent.
to that information by giving them access to that password, which changes every 3 months. You would then be able to allow them to have access to that. And where that's critical, especially if you have elder parents in different parts of the country, that you in turn can utilize that. Somebody gets hurt, disabled, they can't function, you would have access to their information, you being the son or the daughter or the guardian or whoever it would be, that they would allow to have that, and you could help them manage their particular assets as well.
We'll have to do a show on this, by the way.
We will.
We'll do
I
a
mean,
whole show
Yeah,
on
it's,
this.
it's,
Yeah.
but
It's very,
record
it sounds
keeping
very,
is really,
It's
really,
fantastic.
I know.
it's
I know.
overwhelming if you think that you have even 5 different places you have your monies. You have 3 different mutual funds, 2 different CDs at different banks, and a brokerage thing and whatever.
And you have insurance
And
policies,
you have insurance
your
policies
will, and
from
you
the
have your
agent
tax
that passed
returns.
on, and
It becomes overwhelming.
It's
I understand.
overwhelming. I mean, so instead of being overwhelmed, we've set it up so that all of the shoelaces get tied through the one lockbox, and all of your stuff can be coordinated and effectively. And then we can turn around and help you manage what you're doing instead of not knowing where things are,
Right.
when they're due, and
Okay,
it just gives a little discipline to what
We
we're
have
doing.
one more to get to, tax mistakes you can't afford to make, and we've talked about this in previous shows, not considering converting your IRA to a Roth IRA. Lee, this is one of your favorites, isn't it?
Yeah, it's just simple. It costs a couple $1 million for our back office to develop this Roth IRA conversion analysis. It's about a 25-page document, which when we feed your IRAs through the system and your ages and your tax bracket, will spit out for us in tax jargon the effects of converting an IRA or a portion of your IRA to a Roth IRA. It's a tax discussion. It's not, oh, I want to do it, I'm thinking about it. It's a tax answer.
And you mentioned they spent $2 million. You're not asking people to spend
No.
a couple $1 million.
Well, we
Your-
need an
your
hour
company-
of
Well, it's- right.
we need an hour of someone's time.
They spent a lot of money on developing this. is
Yes.
what
Right,
you're saying,
exactly.
And it's a fascinating, it's really, again, most CPA firms are not doing this, and I don't expect them to do this, but as a financial and estate planning management firm, this is one of the things that we bring to the table that is very helpful to individuals who are thinking about or doing planning IRA to Roth IRA conversion analysis. It's an analysis, and we found it to be most of our clients have found it to be very helpful once we've taken their information and run it through the system.
And with that, we are going to put the wraps on another edition of Molotsky on Money. Don't forget, if you'd like to contact Stan or Lee at the SHM Financial Group during the week, we've given you the phone number, the email address, the website. Feel free to contact them. They'll be happy to talk to you any particular issue or situation. And remember that initial consultation is complimentary. For Stan and Lee Molotsky, I'm your host, John DeMasi. Always a pleasure. Thanks for watching. Good night, Jenna. Good night, Alexa. We'll talk to you next time. Molotsky on Money, right here. Take care.
Since 1958, the SHM Financial Group has been providing sound financial insights and strategies for people just like you. Founded by Stan Molotsky, the SHM Financial Group believes in safety, security, and preservation of principal. For more information on how the SHM Financial Group can help you, contact them at 1-800-MONEY-SHM. That's 1-800-666-3974, or visit them at shmfinancial.com.
Throughout our working years, we accumulate as many retirement nest eggs as possible. The problem is, not much attention is given to the color of the eggs. Do you know how much of your assets should be allocated to each color? At our firm, we have a system that helps you allocate your retirement nest eggs correctly. We have a simple way for you to group your retirement assets into red, yellow, and green money. Give us a call today and we will help you sort and label your retirement nest eggs, giving you a clear picture of the color of your retirement.